Is one of the finest fund managers on D Street, Anup Maheshwari, Head of Equity and Corporate Strategy with DSP BlackRock Investment Managers. Anup, good morning. Always fantastic to have you back. Anup, first a word on the price action. Everyone was chasing stocks before the election verdict, but post the verdict, when the uncertainty is out of the system, institutional money has dried up. Large cap stocks are not doing anywhere, and benchmark indices are pretty much jumping in the same place. So even though in terms of bullishness levels, the levels have gone up, but the commitment levels have come down.
Yeah, absolutely, Nikunj. I think, what we're seeing is this market's trying to find some sort of equilibrium after a fairly sharp rise. And, it is a fact, and we all knew that, once you have slightly better market conditions, balance sheets are such that capital raises will come through, and over and above that you also have a lot of large holders in the system for many years who are looking to liquidate some of their holdings. So I guess it's sort of reaching a point where there's a fair amount of supply to also match a bit of the interest that is there. But if you just look sort of beyond the very short run where you're seeing these sort of challenges, I think the fact is over the course of the next year or 2 years, starting from maybe 6 months ago, we started to see some bit of economic improvement. It will be slow, steady, gradual, but it is in the right direction. And I think that will eventually support clearly higher levels for the market overall. Also, valuations continue to be fairly, favorable across the marketplace. There's a fair number of stocks still trading below book value, which to us is an indicator that this market is not very expensive. So maybe a sharp rise needs a little bit of digestion time, but I think the eventual trend seems to be okay.
So Anup, you're saying that the low-hanging fruit has not been plucked. The best of the rally is still yet to come, and at 7,500, there's enough and further upside in the market, right?
Yeah, I mean, best of the rally in the sense, obviously you've seen very sharp price rises as everything is just readjusted. It's like a tide that's pretty much lifted all boats to a certain valuation. So I think that level of readjustment of valuation seems to have occurred for now. But I think from here on it will be, more steady. There will be, a situation where earnings obviously will have to reflect through into some of these prices as well. And overall, I'd say, with economic improvement coming about, with business sentiment being better, with all those multiplier effects that will come through with government action, etc., we should see this market steadily, moving upwards. So it's a matter of time frame management and expectation management. I mean, you can't expect what happened in the last 1 month to keep repeating itself. That's more just a one-time adjustment. But from here, as I said, you should have more steady expectations, but positive expectations.
The small cap index is still up more than 25% in the month of May. So that's extraordinary, and that feat is unlikely to repeat itself. Anup, what is your take on absolute valuations? At 14-15 times, the Sensex is not cheap. But many experts have argued that we should not look at the Sensex P multiple because in beginning of a new cycle, earnings will always lag P multiples. So earnings on paper, valuations on paper, they will look expensive, but 1 year down the lane, 2 years down the lane, they will appear cheap.
No, you're right over there, Nikunj. I mean, what tends to happen is in a down cycle, earnings tend to surprise on the negative side. On an up cycle, they tend to surprise on the positive side. So for the last 4 years, every year we'd all start off with 15% earnings growth, plant the flag there, and end up with 8 to 9% earnings growth. It won't be surprising if for the next 3 years again you start with 15% earnings growth and end up slightly higher this time instead of lower. So that will be one aspect. But the other part, of course, is when we're talking of a Sensex valuation, we're talking of overall an average of many things coming to 16 times. But we're all very well aware of the distortions that have occurred in the last 3 to 4 years within the market. And as I was mentioning earlier, as of now, there's still about 18 to 20% of the CNX 500 companies trading below book value, and that tends to be a good measure. Just to give you a sense, at its worst ever in earlier way back in 2002 and more recently in 2009 when we had the big drawdown, there were about 30 to 35% of the CNX 500 stocks trading below book value. At the peak, there are virtually no stocks trading below book value, which we saw in 2008.
Anup, what is your take on IT in general? Because IT is going through a period of lull and consolidation. Is it a good time to put money to work into IT, because large cap IT stocks are still trading at decent price points?
Yeah, absolutely. I think valuations are quite reasonable at this point in time for the underlying profitability of these businesses. So just if nothing else, even tactically, I think it's beginning to look a little more interesting. Again, one has to be a little stock specific across the board pretty much now in this market. You can't just put a blanket view on every single sector. But I think within IT there are a fair number of names that are now trading at fairly good valuations, and largely because of concerns around the currency, etc. So I think that's a good opportunity to actually look at some of these names again.
Anup, what's the sense now you're getting about what could be the next big trigger? I mean, we've seen the kind of massive move that we had on the election result day, and ever since then the market has again, sort of attempted that 7,500 mark, not really stuck by it though. Do you think now it's going to be the budget which is going to be the next trigger point and give direction to the markets from here?
I'm a little wary of trying to identify perfect trigger points, because invariably I think this is just going to be a process of change. It's not a one-time, there won't be with just a few big bang announcements along the way. I think it's a very gradual process, of course accompanied by certain key changes. But I think the way to look at this is really just over the next 12 months we will see a lot of positive announcements or indications coming through in terms of getting things done on the ground. Typically in the first 12 months of a new government the intent is quite strong, and there is a lot of pressure to get some things done. So I think it's over the course of the next 12 months. Now people will keep looking at certain points of key like the budget for instance, but the fact is that there isn't much time, frankly. It's just about 30 days for the new government to, formulate their policies around the budget. So you don't expect too much from the budget itself. I think it's just going to be a series of good announcements that should hopefully come through right through the course of the year.
So what are the policies?
That's why, we're saying to, from an investor standpoint also, I think rather than have very high expectations getting belied from time to time and volatility, it's just easier to just sit invested through this entire phase and capture the overall uptrend.
Sure. So where do you think policy initiatives could come in? And I mean, is it a blind call that power and oil and gas would be big beneficiaries as well as infrastructure?
Yeah, there's a whole host of areas. It's not going to be focused just on 2 or 3 areas. I mean, there are the very obvious immediate problems that everyone's looking for redressal of. But it's across a whole range of sectors. I mean, we're just talking of overall inefficiency in the system, whether it's in the form of in the agricultural sector through very inefficient distribution, or in coal, power that you talked about, or general infrastructure in the form of a few mega projects that are stuck. Pretty much across the board, taxation has to be addressed, simplification of taxation. I think that's another low-hanging fruit for the government. So there are a whole host of things that need addressal by different ministries, which they will all do some parallel processing on, I'm assuming. So we'll get hopefully a lot of those coming through over the course of the next 12 months. We must remember that it takes time for getting the right people in the bureaucracy also, and therefore to expect everything within 30-45 days is probably asking a bit too much.
But do you think markets will exercise that much patience? Because the run-up in stock prices clearly seems to be factoring in that the NDA regime will do something magical. If we don't hear anything concrete, big in next 3 weeks, in next 4 weeks, do you think the room for disappointment from a market standpoint could be very large?
If expectations build too far ahead of themselves, then sure. I mean, over many years, what we've come to understand is never expect anything magical from any government. I mean, it's very rare that governments will be able to surprise you dramatically, positively, especially when you have very high expectations already. The fact is, this government will do good things. I mean, that is the general expectation, but over a period of time, decisions don't happen that quickly. And therefore, you have to match your time horizon with the change that will occur on the ground, and it will occur, which is why we're very bullish over the next year, 2 years and beyond, But you want sort of very, very high short-term expectations might get belied in this market. So you need to be a bit careful of that.
Anup, what is the best way to bet on economic recovery? Should one buy into cement? Should one buy into banks? Or one should still, stick to consumer and auto discretionary or discretionary sectors, because consumer spending will also come back if economy picks up?
Yeah. I think one is, I think it will be fairly broad brush to start with. It's not going to be a very narrow rally. I think whatever will occur will be pretty much across the board. So banking, cement, construction, all of these sectors that are very naturally economically allied will, should do well. As far as consumer is concerned, there could be lead lags on these sort of sectors. So there could be a bit of a lagged effect for, the consumption cycle to come through. Because typically I think the initial focus will still be on more the manufacturing side than anything else, and then eventually it will lead to better income levels and better consumption as well. But notwithstanding the lead lags, I think overall this market is heading to a higher place, and most sectors within that should do better. So I would say it's pretty much across the board. It should be a good broad-based rally over time.
Anup, when you see over time, does that mean that the best of the rally is going to play out in the next 1 year, or do you think it's going to be evenly divided over the span of next 5 years, and the best is only going to come out at the end of the term of the government?
I wish I could predict that, but we've all been here long enough to know that you can't exactly get it very linear. The point is, over a 3-year block, let's say, things are going to be better and not worse. That's very, very clear to us. And valuations are reasonable. So it's like, when you look at a company, we're always looking for a good business with a good management at reasonable valuations. And that's exactly the way you can define the country today. A good basic economics with a good management and reasonable valuations. And whenever you come across that combination, it just makes sense to buy and hold it, and let markets figure out how aggressively they want to outprice or reprice some of these behaviors. But the fact is, it makes a lot of sense to just be invested and stay put, and not try and be too active, but just participate with the trend and let the trend help you make money.
Anup, what we've seen in last 2 years is that we've seen a highly polarized market. For those who bought quality, those who bought companies with high return ratios, they've made money. But do you think somewhere the polarized nature of the market will change going further, or do you think the polarized nature of the market has already changed and now little mean revision is left?
Yeah. So you're going to ask me this question?
That's right, Anup. That question was for you.
Okay, fine. So as far as polarization is concerned, I fully agree. I mean, that's been the case of the last 3 years. And what we're seeing over the last 6 months already, or since September last year, is that this polarization is narrowing down already. And I think that is going to be the trend over the next 3 years, which is, companies that suffered a lot in the last 3 or 4 years are ones which are probably finding slightly better, more normalized valuations. I did mention earlier to you, I was in the middle of mentioning how there's still close to 18 to 20% of stocks trading below book value, which is still very unusual. It just tells you that there's still fair amounts of pockets of value in the market that need to readjust upwards. And till we get to that more normalized level, I think to that extent there is extra scope for the market to perform. So yeah, the trend over the next 2 years, I would say 3 years, is for, as I said, a more broad-based rally, more normalization of valuations. And the good thing is the defenses, which have to some extent been the extreme end of positive performance over the last 3-4 years, when they go through corrections, their corrections are not sharp and deep typically, so they tend to be more time corrections. So at an overall market level, therefore, the net effect is to raise markets higher. That part of the market won't pull it down too much either. So I think overall you will see broad-based and generally high levels of valuation.
Anup, we've talked about IT, but would this broad-based market move also include FMCG and pharma, or do you think the tilt of the market is purely going to be towards cyclicals?
Well, just specifically on those two sectors, pharma is a sector that we've always liked a lot long term. I think most of the performance of the pharma sector in the last 4 years has been pretty much in line with earnings growth. So we haven't even seen a massive re-rating of pharma names per se. So I think that just continues. As long as earnings growth continues for that sector, the stocks there will continue to perform. FMCG has been the more challenging area, where you've seen actually business slowing down and valuations being very high. So that probably needs some more time to sort itself out. I mean, these are inherently good businesses, but there is a bit of a mispricing in the short run, as has been for the case for the last year or so. So maybe there could be a slightly longer time correction. But areas like pharmaceuticals, I think they just continue to be very good, steady sectors.